The yield curve reinverted 122 days ago after spending 794 consecutive days in negative territory. Historically, that signal alone has preceded every major recession since 1955. At Glacium Research, we monitor the evolution of the global macroeconomy through a wide range of data and leading indicators. Recessions occur roughly once every decade, and those who hold cash during these moments can make the biggest difference in the years that follow. That's why we track macroeconomic signals closely, not only to manage risk, but to prepare for dislocations, moments when every asset is trading at a historic discount. Let's dig into the data, the indicators that consistently anticipate downturns, often months in advance, not opinions, just facts, and patterns that repeat, cycle after cycle. One signal stands out, resilient across decades, and remains unmatched in predictive power: the yield curve. An inversion of the curve preceded the last 7 U.S. recessions, and since 1950, it has correctly anticipated nearly every downturn with just one false signal in 1966. This current cycle is extreme. Between October 25, 2022 and December 13, 2024, the curve stayed inverted for 26 consecutive months. That's the longest inversion in over 45 years. To put that into context, before the 2008 recession, the inversion lasted just 10 months. Before the 2001 recession, only 6. A 26-month inversion suggests something deeper, a persistent stress in the macro environment. Long-duration yields were signaling that the Fed had gone too far, too fast. We're now normalized in that post-inversion window, and the clock is running. From February 2022 to July 2023, the Federal Reserve raised interest rates from 0.25% to 5.5%. That's a 525 basis point hike in just 17 months, one of the fastest tightening cycles in modern history. It was an emergency response. Inflation had peaked at 9.1%, the highest level since 1981. But with that, a decades-long trend was broken. Since the early 80s, every rate cycle had peaked lower than the last. This time, the pattern reversed. Then came the plateau. From July 2023 to August 2024, rates held steady. Policy remained tight. And then, the pivot. On August 31st, 2024, the Fed cut rates. Historically, that moment matters. Since 1990, every major rate cut, following a hiking phase and a plateau, has been followed by recession. For now, the first cut has taken place. The clock is ticking again, but the real cuts haven't started yet. Why does it matter? Because the Fed sees the cracks before they're visible. It has access to data others don't, and its mandate forces it to move early, before the slowdown becomes official. Today, we've entered that same phase. The Fed has pivoted, and history suggests what's likely to follow. Some signals aren't found on charts. They come from capital allocation decisions made quietly by those with decades of accuracy behind them. Warren Buffett is one of them. His positioning has often aligned with key market reversals, and right now it deserves attention. Glacium Research tracks it as a macro signal. A detailed breakdown of Warren's Buffett current liquidity stance, along with its historical patterns and implications, is available in PDF format. Link in the description. Submit your email to receive the Buffett Positioning Report. Now, let's focus on unemployment, a key economic indicator, and one of the most telling signals in late-cycle environments. In April 2023, unemployment reached a low of 3.4%, the lowest level since 1969. For months, the labor market looked resilient, and in many ways, it still is. But something has changed. The unemployment rate has started to pivot, and historically, that pivot is always a warning. Every single recession in the past 50 years was preceded by a turning point in the unemployment curve. And once the rate begins to rise, it never returns to its previous low, not until the recession is over. That's exactly what the chart shows. Look at the curve. Each cycle, the bottom forms, and then the trend reverses. We've already entered that phase. At Glacium Research, we track employment data closely. Not just the headline numbers, but what's beneath. The unemployment rate is now giving us a clear message. The recession isn't here yet, but it's already on the way, and there's no turning back. Now let's turn to housing. More specifically, new home supply in the United States. It's one of the most overlooked macro indicators that we are always watching very closely. And right now, it's flashing a clear warning. The current supply of new homes has climbed above 8 months of inventory after previously hitting more than 10. Historically, every time this number crosses 8, a recession follows. Before the 2008 crisis, new home supply peaked at nearly 12 months. In the early 90s and early 80s, the pattern was the same. Excess inventory means one thing: demand is weakening. When developers can't sell, they stop building. And when construction slows, so does everything else: employment, credit, consumption. Housing is the backbone of the U.S. economy, and when the supply curve steepens, it almost always leads the slowdown. Today, the data tells us we're there again. Inventory is rising, sales are softening. The housing cycle has already turned. Now let's take a quick look at heavy truck sales. This data is simple and powerful. Every time truck sales peak and start to decline, a recession follows. Why? Because trucks move the economy. They carry goods. They fuel construction. They support industrial demand. It means companies are scaling back. Less goods to move, less need for new equipment, less confidence in future orders. Right now, we're not seeing a collapse. Not yet. But truck sales have reached extremely high levels only seen before major downturns. And over the last few months, momentum has started to fade. It's early, but the signal is there. Now let's look at credit spreads. More specifically, the gap between high-yield bonds and U.S. Treasuries. This spread reflects how much risk the market is pricing in. And historically, when it rises sharply, a recession usually follows. We saw it in 2001, in 2008, and again in 2020. Today, the spread remains low, but something is changing. It's starting to rise. Quietly, but consistently. Investors are beginning to demand more yield to hold riskier debt, which means only one thing: confidence is eroding. Credit markets often see the cracks first, and right now, they're beginning to widen. Credit markets are flashing early signs of stress, but households are already feeling it. Debt is rising. Total credit card balances just crossed $1.2 trillion, a new all-time high. But it's not just the amount, it's the cost of that debt. Today, the average interest rate on credit cards is over 22%. For new offers, it's above 24%. Nearly half of U.S. cardholders carried a balance at some point this year. Many in high-cost states, with average debts over $9,000. That combination is explosive. More debt plus more interest equals less margin for error. And now, delinquencies are starting to rise. When balances hit record highs and repayment slows, it's not just a consumer issue, it's a macro issue, because consumption drives the U.S. economy, and the consumer is running out of room. Debt levels are at all-time highs, interest rates are near record highs, and now, the defaults are accelerating. Delinquencies on credit card debt have more than doubled since 2022. The share of balances overdue by at least 30 days has climbed from 1.6% to over 3.3%. That's the fastest jump in more than a decade. And it's not over. This is no longer just about balances. It's about the inability to pay them back. Even with a strong job market on the surface, consumers are falling behind, quietly but steadily. And that's what makes it dangerous, because delinquencies don't spike overnight. They build up slowly until the system breaks. We're not there yet, but the pressure is mounting and the data is clear. Credit cards aren't the only problem. Consumer loans, auto loans, personal loans, and more have surged since the pandemic. Today, total balances are near record highs. And just like credit cards, the cost of borrowing has exploded. Average auto loan rates now exceed 8%. Personal loans, often over 11%. That's the most expensive consumer credit we've seen in decades. And it's starting to break. Auto loan delinquencies are rising, more buyers are missing payments, repos are accelerating. The trend is clear. Households are not just borrowing more, they're struggling to keep up. It's another crack in the system, another signal that the foundation is weakening. The signals are there, across credit, labor, housing, and rates. History doesn't repeat, but it rhymes. And right now, the pattern is hard to ignore. The curve has normalized, the pivot has begun, delinquencies are rising. The clock is ticking, but at Glacium Research, we believe the odds still favor a last bullish window before the recession hits. Trump may have been ready to tip the economy into contraction, but the pressure from long-term bond markets forced him to step back. In our view, there's still time, a few quarters before the storm. Are you ready for what comes next? Do you have cash on hand, ready to benefit from a recession?